Hello, everyone. Thank you for joining us today for this webinar. My name is Pierre Cléroux. I'm the Vice President Research and Chief Economist with the Business Development Bank of Canada, BDC. For the next 30 minutes, we will be sharing insights about the economic effects of the COVID-19 pandemic, as well as practical advice to help mitigate the impact of the current situation on your business. We will begin with our economic outlook for 2020, so we can know what is lying ahead. My colleague Alka Sood from Advisory Services will join in for the second half of the webinar with practical advice to proactively get through this situation. We know that times are hard for many of you right now. It's never easy to see a sudden shock in the economy like we are seeing now. But it's even more difficult when we are also worried about the health and well-being of our family, employees, and other people around us in the community. Is there one message I want you to take away from this presentation is that the current situation won't last forever. These types of epidemics have generally been constrained in time, and the fundamentals of the economy remain strong. We will be sharing strategies that you can implement right away to help you through to a better time, with the hope that you will emerge from this period even stronger than before. Before we begin, I want to mention that we will not be going into details about BDC financing. All details relating to our loan programs can be found online at bdc.ca or by contacting your account manager. Another housekeeping note, because we're recording this webinar from a distance, we will not be able to field questions live. My presentation has two parts. First, I'm going to talk about the current economic situation in the world, in the US, and also, of course, in Canada. Second, I'm going to present two possible scenarios for the recovery. So first, the current economic situation. Well, first we're going to look at the world economy because, as you know, the Canadian economy is a very open economy. So what's going on around the world is really having an impact here. The world economy is already slowing down, and we expect the world economy to be in recession in 2020. There's a number of forecasts, but all are showing negative growth for this year. One of the impacts of the slowing down of the world economy is on commodity prices. Most commodity prices are going down, and the most important one for Canada is the oil price. The slide that you see now is the evolution of the price since the beginning of the virus. You can see that there's actually two shocks. The first one is when China started to have this virus, and you can see that the world demand for oil started to slow down, and that really had an impact on the price. But a few weeks ago, we got a second shock, a world price war between Saudi Arabia and Russia. The two countries couldn't agree to reduce supply and support the price. As a result, on top of the current situation, we also have an oil price war. Unfortunately, we don't know how long this is going to last. But our forecast is that the oil price is going to remain low for the next few months. Second economy I want to talk about is the U.S. economy. It's an important economy for the world. It's still the #1 economy in the world, and also it's our main trade partner. 75% of Canadian exports are going to the United States. As you can see from the graph, our forecast for this year is a negative growth for the U.S. That means the U.S. economy is going to be in recession in 2020. If you look on the right side of the slide, you can see our forecast per quarter. And then you see the shock. The biggest shock is going to be for the second quarter. For the next month coming, we believe that the U.S. economy is going to contract by more than 10%, which is really severe. However, we believe that the economy is going to improve during the third quarter and rebound during the fourth quarter. However, despite the rebound by the end of the year, the U.S. economy will be in recession in 2020. One of the first data to show that the U.S. economy is really slowing down is on the manufacturing sector. This graph is showing that over the last 2 weeks, we saw the level of activity in the manufacturing sector has really slowed down. The impact of this crisis is also very felt for people. Last week alone, 450,000 Americans claimed for unemployment insurance. As you can see from the graph, this is way bigger than anything we have experienced over the last few years. As the economy is slowing down, different government organizations in the U.S. are reacting, trying to help the economy to recover. The Federal Reserve, the central bank, has reduced interest rate to 0%, helping the economy and especially supporting the growth during the recovery. The U.S. government also announced a massive program to support the economy. We're talking to more than $1 trillion that are going to invest in the economy to support people and businesses during the downturn. For example, there's going to be a huge support for the airline industry. As you can imagine, they're really affected. $500 billion are going to be sent in direct transfer to people who are losing their job. There's also going to be funding for small and mid-sized firms in the U.S. So what does it mean now for the Canadian economy? According to our forecast, the Canadian economy will also be in recession in 2020. Our forecast is actually a contraction of 1% for the year. As you can notice, the contraction is actually bigger than the one in the U.S. And the reason is not only the virus is causing a shock on the economy, but the oil price is also causing a shock on the Canadian economy. When we look quarter by quarter on the right side of the slide, we see a similar pattern than in the U.S. We believe that the Canadian economy will have a severe contraction in the second quarter. Recovery is going to start in the third quarter, and it's going to take the end of the year before we see a significant recovery. The impact is already felt by many small and mid-sized firms in Canada. We did a survey last year to understand what is the impact on Canadian businesses. 73% said that they have a negative impact already. This is major only after 1 week. The biggest impact for businesses is the lack of demand. 52% of Canadian businesses said that they have a negative impact because of lack of demand. 35% said it's a lack of demand, but also a lack of supply. They have a trouble with the supply chain. So as you can see, the impact is really massive for small and mid-sized firms. The impact of the current situation is also important for many Canadians. Last week alone, 500,000 Canadians filed a claim for unemployment insurance. This is by far a record. As you can see from the graph, this is really increasing the number very, very significantly. To respond to this situation, the Bank of Canada has reduced interest rate to 0.75%. The idea is to help the economy to recovery. And they said that if they need to do more, they're ready to go even lower. The federal government also introduced a number of programs to support Canadians and Canadian businesses. First, on Canadian, they're going to increase transfer to people who lost their job but don't have access to unemployment insurance. They will also allow Canadians to defer their tax payment until August. So this will leave money in the economy to help Canadians to go through this period. On the business side, the government has introduced a number of programs to help small and mid-sized firms. One of them is to give access to more credit through BDC and EDC. They also are going to support the private banks so the private banks can continue to lend money to Canadian and Canadian businesses. They have a program of 10% wage subsidy for small business for the next 90 days. So the Canadian government is going to invest about $27 billion in the next month to ease the recession on Canadian and to help the recovery. The result of this turbulence is having an impact on the Canadian dollar. The Canadian dollar already lost decline from 75 cents to 69, we believe the dollar is going to remain low for a few months. There's two reasons for that. First, the U.S. dollar it's really stronger than before, and as a result, it has a negative impact on our dollar. The second, the fact that the oil price is really declining, this is having a negative impact on our dollar. So as a result, we believe our dollar is going to remain weak for the next few months. The last part of my presentation is about the recovery. It's hard at this point to understand clearly how the recovery is going to happen, but there's two potential scenarios that I would like to present. The first scenario is a severe impact, but a temporary impact, with a recovery by the end of the year in Canada. The second scenario is a more negative scenario with a long-term recession. If, for example, some countries around the world are not able to fight this virus, the impact on the world economy is going to be much longer, and we can expect a long-term recession. Right now at BDC, we work with the first scenario. If we look back, we believe that the impact is going to be, the shock that we have on the economy is going to be severe, but it's going to be temporary. And there's two reasons to believe that. The first reason to believe that this shock is going to be temporary is what China has been experiencing over the last few months. China was the first country to have to fight the virus, and we can learn from their experience. The impact of the virus on the Chinese economy was very severe and very strong. For example, retail sales dropped by 20%, industrial output dropped by more than 10%, and of course, millions of people lost their job. But the good news is after 2 months of fighting this virus, the Chinese economy is recovering. 95% of large businesses are back and running. 60% of small and mid-sized firms are running now. And we can see some positive economic activities from China. A good example that the Chinese economy is rebounding is the fact that confidence from consumer is coming back. Over the last few weeks, we saw that the index of confidence is actually improving in China, which is a sign that the Chinese economy is recovering. So after a few months of fighting this virus, the Chinese economy is rebounding. The second reason why we believe that it's possible to rebound by the end of the year is the fact that governments in North America have been investing massive amount of money to recovery. In the U.S., we're talking about more than $1 trillion that are going to be spent to help to ease the recession and to help the recovery. In Canada, the Canadian government is spending more than $37 billion, and that's not including investment made by different provinces across the country. So this is really going to help the Canadian economy to rebound in the second part of the year. I was often asked over the last 2 weeks if the Canadian economy, the Canadian government can afford to spend that kind of money to help the economy. Well, there's a good news in Canada, where debt to GDP ratio in Canada is the lowest in the G7 countries. So Canada can afford to support the economy for the next year. So to summarize, the impact on the economy is going to be severe. We expect a major contraction in the second quarter, but we still believe that the economy is going to rebound starting in the third quarter, and the rebound is going to be felt strongly in the fourth quarter. So the economic impact of COVID-19 will be very severe in Canada, and it will put the Canadian economy into a recession. Well, we believe that the recovery is going to be felt by the end of the year. Now I would like to introduce you to my colleague, Alka, who works for the Advisory Services, and she will talk about practical advice to go through this difficult period.
Thank you, Pierre, for the economic overview. We now know what to expect over the next weeks and months. The remainder of this webinar is focused on giving you concrete tactics that you can start to work on right away. So you need to have a continuity plan that sets out preventative measures in the event of a potential threat or disruption like COVID-19. The goal of continuity planning is to sustain ongoing operations, albeit at a lower level of capacity, and to enable recovery in a constructive way. We've all been forced to adapt to what is going on, and we must work through this. From our perspective, we suggest that your immediate priorities are to first and foremost prioritize safety and communications. The health and safety of employees is absolutely crucial, and communication with everyone, including your suppliers and your customers, is equally as crucial. Everyone is looking for information, so share. Secondly, you are a business, and your financial and operational stability is also critical. To endure, you must build resilience and have the financial resources to not only go through the lag, but also to be ready to operationalize once the threat subsides. Creating a continuity plan will give you the clarity you need, help you anticipate and respond on a day-to-day basis, and allow you to control your cash flow, and most importantly, establish operational resilience. So what are the strategies you can take? COVID-19 is a human problem. A human response is in order. So let's take care of our people first. Here are some important questions you can ask yourself. For those of you who are still in operation, identify the health and safety practices that you must take to prevent further transmission of infection. Institute the necessary safe distance practices and incorporate the use of gloves, plexiglass barriers, for instance, and so on. Do what is necessary. There are other measures beyond what we've listed here, and it's up to you to figure out what they are. Finally, be sensitive to your employees and the personal distress that they must be going through. Do what you can to help them out. This will go a long way toward building employee loyalty. As I stated earlier, you can never communicate too much. Prepare a communication plan, target your employees, your customers, and your suppliers. Carefully craft a clear and concise message, schedule regular updates, and optimize technology to send your messages. Put someone in charge of this. It's an important job. So this brings me to the core of our discussion today. Most business actions can be represented by financial transactions in both good times and bad times. So as you start to make changes in the way you do business over the short term, there will be a corresponding effect on your cash flow. As you plan changes, also take the time to understand the financial impact of these changes and develop the cash flow plan alongside. Next, we will discuss specific business strategies that are important to keep in mind as we will illustrate how to capture the financial impact. So why is this important? It will tell you how much working capital you need over the next 3 to 6 months. Let's begin with your customers. They are your normal daily source of cash. For those of you continuing operations, call your main customers and confirm that existing and planned orders that are in process are still on track. You do not necessarily need to renegotiate payment terms, but rather you may need to defer production to later on or loosen repayment terms, which will slow down your incoming cash. Understanding the timing and value of key milestones is important to understand your cash flow. You may see an increase or decrease in your cash flow. You may see delays. Secondly, start calling each of the customers that owe you money. You need to understand whether they have the ability to pay and timing of payment. By being proactive, you can start to forecast the possible timing of these inflows and then have more clarity around when the money may come in. Over the next 6 to 12 weeks, keep an eye on this regularly. If a customer promises to pay in 2 weeks, follow up with a gentle reminder 1 week in advance and invite them to be open with you if they're still experiencing difficulty. Communications are essential, so put the right person on this job too. It cannot be avoided and must be one of the top 3 things you review every morning from here on. You may see an increase or decrease in your cash inflow. You may see delays. Finally, as you reach out to your customers, be courageous. Ask them if they need anything else. It's possible that another supplier has let them down. Maybe you can fill the gap. Look at this as an opportunity to explore other options. You may see an increase in your cash flow. So now let's look toward your suppliers. As reported around the world, supply chains are constrained, and if your supplier is overseas or relies on imports, you risk disappointing your customer. Call suppliers. Confirm whether existing purchase orders will be filled on time and whether they can meet your shipment quantities. You may need to delay production, and it's wise to know this early on so that you can manage your customers' expectations. You may experience lower cash outflows if suppliers are delayed, or if everything's on track, your cash outflows may increase. With your payables, try to negotiate deferred payment terms if you can. Like receivables, you need to keep an eye on this regularly. If you promise to pay a supplier in 2 weeks and cannot, give them advance notice. You expect it from your customer. Extend the same courtesy to suppliers. Again, you may experience lower cash outflows if suppliers agree to later payments. Finally, as you change your health and safety practices, there may be a need to source other types of consumables. Be prepared to spend the money on this. Plan for replenishment just as you would for other materials and consumables. Now for the other things you need to do beyond managing customers and suppliers. You will need to change your health and safety practices. Industry leaders, for example, are telling customers how they are packing, handling products in light of COVID-19. You have the same responsibility. This will have a cost impact. Estimate the impact, factor it into your plan. As demand dips, alignment of your personnel to production will be your next challenge. Some of you have already dealt with this. Others will need to deal with it soon. Third, look to find recurring operating expenses that can be suspended in the short term. Would your landlord be amenable to a postponement of rent? Can you temporarily reduce some of your communication expense? Can you stop getting laundry services for uniforms? A line-by-line review of your expense items is critical to see where you can shave cost over the short term. Every penny will count. You may also find other more sustainable cost savings from which you will benefit after recovery. As each new invoice comes in, question whether the expense is really necessary. And of course, this is obvious. Simply defer discretionary expenditures. Example of these could include meals, travel, and so on. So we've now given you some very specific strategies for your business. Putting them all together into a cash flow plan will allow you to determine exactly how much working capital you need. Here we present a spreadsheet that itemizes the cash flow from week to week. This is a little complicated, so let me take you through it slowly. This is merely an illustration. Notice that we refer to it as a rolling cash flow forecast. So this would need to be updated at the beginning and end of each week. It is forward-looking over a 13-week period, but you may need a longer duration depending on the unique circumstances of your business. The cash flow plan acts like a GPS for your business. For example, your car has a gas gauge. Cash is fuel for your business. The cash flow plan is your gauge for how much working capital you need until post-recovery. First, we list the cash inflows, receivables, cash sales, other subsidies, whatever else that you have found while you've been talking to customers and other people outside your organization. For illustrative purposes, we show how cash inflows from receivables fall as the weeks progress. This may not be true. Remember, this is only an illustration. Next, we list the cash outflows, payables, recurring monthly expenses, and so on. By now, you've analyzed your expenditures, have taken remedial action to right-size not only your employees, but also your other operating expenses. You have mapped these out over time. You have a sense of how your money is going to leave the business. We've included your lending obligations. This is all part of your cash flow. If you plan to buy new equipment, you may want to reconsider the decision once you've developed your plan. This statement looks very much like a bank statement. In this case, the entrepreneur at the beginning of the week has a starting cash balance of $2,000, expects to have a net outlay of $1,100, and will then have a lower cash balance at the end of the month of $900. So he or she is good for week 1. But look at what happens in week 2. The outflows start to drain the bank account to a deficit position. And over time, after say the 13th week, there is a shortage of $20,750. I know in your minds you're all thinking, my number is going to be bigger. Well, this is a good time to figure out what that number is for you. This will inform you how much working capital you need, and you will then have all the right information to support your working capital loan request. Of course, if you love cash flow modeling and have the time, you can look at different scenarios and so on. It's all up to you. Your accountant can help you too. So call them, see if they can. Time is of the essence. As Pierre said, there is a light at the end of the tunnel. We just don't know how long that tunnel is. Here we have overlaid business activity against active COVID-19 cases. You will see that once the cases have peaked, we will recover. At this time, stay ahead of the game and start to plan and execute your recovery plan. Orders will firm up. Then you'll update your financial plan, purchase materials, recall employees, receive new shipments, operationalize. Regardless, plan your cash flow for the recovery phase as well. When things start to turn around, you will need to spend money to earn money. It would be a shame to ride the dip and then not have the optimal resources to bring your business back to normal. In our opinion, all your plans should include a 4-week recovery period. As you roll your cash flow forward each week, this recovery will be automatically built into your working capital estimates. With orders back in, your business will strive and you will have the funds for operations. As always, there is a need to stay on top of your game. With regard to your customers, update your sales forecast weekly, actively pursue collections, maintain open communications. With human resources, look at your personnel count regularly and calibrate. Refine health and safety standards continuously. With operations, revise weekly sales forecasts and adjust your operations plan continuously. Monitor KPIs and make sure that you're using your resources efficiently. And with cash management, update your cash flow regularly and scrutinize those disbursements meticulously. The main message of this slide is to emphasize how important it is for you to monitor and communicate with your customers, your suppliers, your employees, and your lender, of course. In summary, maintain your composure. When you do this, you'll be disciplined when executing your operational and cash flow plan. Keep up your communications, of course. The most important thing. And remember, the BDC is here to help. We know that the current situation is putting pressure on your supply chains, your cash flow, and your people. Here is what we're doing to help you get through this. We're offering additional support. BDC clients with loan commitments of $1 million or less may be eligible for a postponement of principal payments up to 6 months free of charge. You can make the request at any time on your online client space portal accessed through bdc.ca. You can also rely on our advisory services experts to support you and review your financial management and operations practices. If you are not a client and believe you need additional working capital to get through this crisis, you should first contact your main bank to assess your situation. The Office of the Superintendent of Financial Institutions has lowered the chartered bank's capital buffer requirements to support in excess of $300 billion of additional lending for Canadian businesses and households. This should make it easier for entrepreneurs to get a business loan through their commercial bank. Your bank will refer you to EDC or BDC if your needs extend beyond what they can offer you. Qualified businesses will have access to working capital loans of up to $2 million with flexible terms and principal postponements of up to 6 months. Only businesses that were financially viable before the impact of the coronavirus will be eligible. We are closely monitoring the situation and will adjust our measures according to the needs and directives from the government. While all BDC employees are mobilized to support you, we are receiving a high volume of calls and requests. We're working to increase capacity, and we thank you for your understanding. The Government of Canada has taken strong action to help Canadian businesses as COVID-19 is affecting them, their employees, and their families. Visit canada.ca/coronavirus to access the various support programs that have been put in place to help you through these difficult times. Entrepreneurs can also visit BDC's Information Hub for Entrepreneurs at bdc.ca/coronavirus. We will be updating this site regularly with tools, more details about our financing solutions, and additional measures to help you through these difficult times. We understand it's not an easy time to be an entrepreneur, but please know that you are not alone. While you focus on your health, of your loved ones, and of your employees, the health of your business remains our top priority. As Canada's Bank for Entrepreneurs, we not only want to help your business get through this, but also to emerge stronger. Thank you.